Hello everyone, this is Terry with Futures.io. It's my pleasure to welcome back FuturesTrader71 for today's webinar, Changing Markets, Picking and Preparing to Trade a New Product. If you have a question during the webinar, please feel free to type your questions into the questions box and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @FuturesIO. And without further delay, I will hand it over to FT71. All right, FT, you should get the pop-up to share.
Okay, thank you. Let's roll. Okay, you should be able to see the slide.
Yep, looking good.
All right. Good afternoon, everyone. Thanks for joining. This session is jam-packed with information. You're not going to be able to keep up with the notes and stuff. I strongly advise you to check it out once FuturesIO puts up the information on YouTube. Essentially, what we're doing today is, if you looked at the webinar series that I created for charity back in 2010, webinar 1, 2, 3, 4.1, and in 4.1 I talked about webinar 4.2, which would go into how to do homework and research, and I never actually created webinar 4.2 for several reasons. One of them was my involvement with stage 5, and that took up a lot of time. We ended up covering a lot of material in the chat room and the private AMAs there. But when Terry approached me, Terry and Mike approached me about having a talk, I've been talking so long on FuturesIO and I've shared so much, I thought this would be a good topic to get into. I want to also emphasize that the information I'm sharing is based on statistics and it's based on opinions, okay? So derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The nature of statistics is such that they're always historical, they're always backwards looking, and the probabilities that are represented by the historical data do not necessarily indicate the probability of a specific outcome. In this case, we want to win, right? We want our traders to be winners. So just remember that as we go through the numbers. There is a lot to cover here, and I do have some things that I want to build into, but the key piece of all of this are the stats, which I'll get to as quickly as possible. So I'm not going to take any questions. As I'm going along, I'm going to very quickly rush through these slides because it is background information that you need to have. I want to get to the spreadsheet, to the statistics, okay? So, oh, hang on, yep. So the question is, why would you change markets? So, you know, recently, for those of you who watch my Trader Bites, you probably noticed me talking about how dull the trade in the S&P has been. Yes, you can still make money in it. Yes, you can still lose a lot of money in it. But overall, the auction has been quite poor. We've got record sequences of making new highs. Volatility is relatively low. And the opportunities are very, very tight and very sparse. You know, instead of getting 6 to 10 setups a day, you might get 1 or 2 setups, and if you're, it's almost a binary trade. So in that case, you know, if the market cycle doesn't change such that you can take advantage of your trading plan like you normally would, it may be time to think about changing markets. So a change in market cycle that is unfavorable to your trading style, low volatility, low liquidity moving elsewhere, geopolitical environment, that sort of stuff, it might spur you to have to look at a different market. I want to make sure that if you're going to make a move to a different market, that you do it in as professional a way and as comprehensive a way as possible, and that's what this webinar is about. A change in specifications, rules, tick size, costs, or margins could force you to change your market as well. For example, when I traded equities, when I was basically market making NASDAQ equities, once we went from teenies, fractions to decimals, it essentially cut down on our profitability, from 1/8 or 1/16 or 1/8 or 1/16 of a dollar to a penny. That kind of change could really spur things on. Costs, margins, much higher margins could change, could force you to change markets. Infiltration by participants that negate your edge. For example, you're a very short-term scalper, and all of a sudden the market's taken over by algos or much larger scalpers who are spoofing the market. A change in your account value. You can't trade the product that you wanted because your account's depleted, or you don't want to trade the product you were trading because your account size is big enough. For example, if you're moving from the M6E, the micro euro forex account product, to the full euro futures product, the 6E. A change in your risk tolerance, your family situation, divorce, somebody passing away, new baby, all those things can change your risk tolerance so that you can't really be free to put on as much risk capital as you'd like. Okay, evaluating your risk tolerance. Understanding a market requires you to understand yourself. So I've talked about this a lot. I've done a lot of talks on this. You really need to understand who you are when it comes to risk. Are you patient enough to wait for a market to unwind in favor of your position? Like right now in the S&P, you might put on a position. So we've had a little bit of movement here in the last couple of days. But last Friday, after the non-farm payrolls, the session was pretty sideways, pretty dead. You might put on a position and just watch as the market just sits there, moving a couple of ticks against you, then back to scratch, then a couple of ticks against you, then back to scratch. You could be sitting there for an hour and a half before the market actually tells you if your position is going to be treated in favor or not. Do you have that risk tolerance? Do you need a market that moves in your favor quickly enough to cover your initial risk? This is where I fall. I like to be in a market that tells me very quickly whether I'm right or wrong, so that I can take the next trade and the next trade. My priority as a trader is to exploit my edge with as many data points or as many tries as possible. I would not do well in a market where I only get one trade a day and it's binary. I make money or I lose money and that's it. I want to be in a market that gives me a dozen setups in a day that allow me to take small chunks throughout the day. Are you capitalized enough not to use too much leverage? Are you trying to trade the Eurex full-size DAX at $19,000 per contract and margin, or I think it's 19,000 euros, which is about $23,000 in margin, with a $5,000 account? Are you over leveraged there? So you need to understand your own risk tolerance as part of this decision process. Are you accepting of a market that continuously overruns anticipated turning points? So if a market's less liquid, like crude, like the NASDAQ, like the DAX or the Russell, it has tendency, even though it might respect a price zone, a support resistance zone, it is likely to run through it because there isn't that liquidity to respond to the market at those certain areas if you are right. So that's another thing you need to consider, that you have to sit through these drawdowns for a short period of time. What information is needed? Okay, you don't want to trade a new market without knowing at least the following. What are its active trading hours? You need to know when the market's trading in its primary session versus its overnight Globex or secondary session. You need to know what the underlying commodity is and its key factors and influencers, right? Influence factors, that should say. So you have to know that crude oil is a physical product. It does not have an underlying. It is the underlying. The price of the underlying product of crude is a barrel of crude, and it doesn't have like a cash market. It doesn't have an underlying security. That's important to know, and it's important to know what influences that market. Is it geopolitical stuff, supply demand, or is it earnings and news releases and things like that on key stocks? Oops. What is the margin requirement? This is really important. Margin, for those of you who here does not know what margin is, real quick. Does everybody, who does not know what margin is or what margin is based on? How does an exchange determine what the margin requirement is? Does anybody not know how that's done? I would guess that most of you do not know why the margin for a certain futures contract is what it is. Okay, and the margin requirement, if you look at the specifications, the exchange specifications, essentially what the exchange does is it studies third standard deviation moves. So it basically says if the market moved, had a move that covers 99.2% of all ranges in the last period of time, whatever that period is, on one contract, how much money do you have to remain solvent, right? So right now in the ES, the margin requirement, I think it just recently changed. Let me look up what it is real quick. The ES margin right now is $4,950. And what the exchange is saying by giving you that amount is you'll need to have at least $4,950 per contract to be able to withstand and not go negative in your account 99% of the ranges available to the S&P within the last, I think, year or something. So margin is a very good indication of how much the product moves, how much risk there is. What is its typical range in your trading time frame? So if you trade in a daily time frame, like you're an intraday trader, what is the typical range in that time frame? How much movement should you expect in a 5-minute rotation, 1-minute rotation, and so on? We'll cover that. What is the cost per contract for trading it? Trading something without knowing the cost is not so smart, right? Because you may have a good price for trading the S&P and the NASDAQ, but you may have a terrible price through your broker for trading crude oil or the Russell or some other product. Some brokers will charge $49 per side as a default rate, and you have to see it in your statement. And you have to go and ask them to reduce it to a more reasonable level. You should know what things will cost before starting to trade them. How is it settled? Is it physically settled? Is it financially settled? If you held a contract to expiration, are you going to get a call to buy 1,000 barrels of crude to pick up 1,000 barrels of crude? Or is it financially settled in that you'll just be given the money in your trading account, or the money will be taken out of your trading account? That's very important, because if you're trading a product that is physically settled, you have to make sure you roll or exit the position before settlement. Otherwise, you're going to be stuck with a physical settlement or a large penalty. When does it roll over? When do you go from trading the September contract to trading the December contract? It's important to know how the product is behaving. And when does it expire? Is it on the normal March, June, September, December cycle, which is a lot of what the financial products are, or is it like coffee, where it's got different months where it settles versus a normal cycle? You need to know what that is also. So next, I want to talk about the raw edge in the higher level statistics. So to conduct this study, and this is the part that applies to webinar 4.2 on my website, what is the process of doing this homework, right? So I've done the homework kind of like those cooking shows where they show you how to cook something, and then from underneath the counter, they pull out and they have this huge, roast beef that's already been cooked, so you don't sit there and wait for 2 hours for it to cook. I've done the same thing, but you're going to see the same kind of, the process is quite can be quite complex or simple depending on the questions you ask. But the first thing you need to do to study is be organized. What is the exact thing you're looking to answer? If you've ever done a statistical study, you'll find that it's so easy to get lost in the details. You start massaging numbers around a spreadsheet, and next thing you know, you're digging and digging and digging, but you're not really answering any questions. So list all the questions you want to answer independently. List them out so that you can focus on answering those questions first. Don't try to ask a compound question. In other words, don't ask a question like, what is the range of the initial balance on Thursdays for the last 252 days or 1 year of trading? What you need to do is say, what is the range of the initial balance? Then you need to take that and then look at Thursday and answer that question. And then you need to apply that information over 252 trading days. So you need to break it down, because what you'll find is if you break down the question, the data that you get for a question can be used elsewhere. But if you combine the information and answer a compound question statistically, the data cannot be extracted and you'll have to do it again. It's hard for you probably to perceive what that means until you've done a couple of these, where you do a lot of work and then you realize later that you wish you hadn't lumped a bunch of percentages or statistics together, that you should have broken them out so that you can reuse them when you need them. Stick with answering the questions first when doing your research. Don't get caught up and distracted. Decide on the product you wish to study. So to decide on the product you wish to study, you have to look at you have to evaluate your risk tolerance. You have to look at the basic information that is needed, and then decide that, okay, this may be a product that I'd like to look into, and then you start digging into the statistics. Once you figure out what product you want to use, scrub your data. So if you look here, so for the research I'm about to share with you, I used a 60-minute chart, okay, of the Russell. So this whole talk is going to be focused on the RTY contract on the CME. The RTY started trading July 10th. It is the same contract as the TFS contract, or the Russell 2000 contract on ICE. And I just did my studies on the RTY. The data, my data feed is IQ feed. Highly recommend it. And what they do is they mix the data, right? So they pull the Russell data and they superimpose it on the Russell ICE data, superimpose it on the CME data, and then they start tracking the CME from the time it starts trading. And what I do is I export this chart. So I export all chart data, okay? So what I end up getting is something that looks like this. The charting package I'm using is Investor RT. I get something like this, and what this is doing is it's grabbing all of the data points, including over here to the right, the open, high, low, close volume, the volume for each 60-minute bar, the IB high, yesterday's low, yesterday's high, a lot of information, the IB low, the IB high of the session, and so on. And then the next step I start to work on when I'm doing the study is to scrub the data. I want to make sure that I'm not doing homework on a spreadsheet or a data set that contains holidays, for example, shortened days. All of those need to be removed. If I have holidays in here, it's going to impact, it's not a huge data set, but it's, over a period of 2 years, I'm going to have at least 8 holidays a year. And after a while, those holidays could have an impact on my statistics. So I create a formula that checks to make sure that each day ends, and these are all Chicago times, each day ends at 3:15, which is 4:15 Eastern, and starts, and then the first bar ends at 9:30, ends at 9:30, which means it started at 8:30 Central and ends at 9:30. So if these two don't, if the prior day doesn't end at 15 and start at the 9th hour of the day, then I know that, that one of those days is shortened. So I run a filter, and here's the cooked roast beef that I talked about. Here's that same spreadsheet, but now it's cleaned up, right? So the first thing I do, I pick off the hour. I ask Excel to go and get the hour of each bar. So let's remove this filter. So this is the sheet unfiltered. And so it looks at the time and it says, okay, that's 9 o'clock, 10 o'clock, blah, blah, blah. And then I have a formula that checks to see, okay, are we going from 9 to 9 o'clock? So if this session started at 9 and so many boxes away, I have another 9 o'clock session, then this is a full session, then it's okay. So all of these, once I clean it up, all of those end up being true, which means that every day included in the spreadsheet, which ended on the 6th, every day included in the spreadsheet is a full day. So that's the first step that I do. I also remove a lot of the columns that I don't need. For example, the spreadsheet I downloaded has a lot of columns with zeros in it. I don't need those. I don't need the zigzag change, price, notes. I don't need multiple indications of the time of the day. All that stuff I'm going to clean up. So the first step of this process is really to scrub your data and clean it up and get it ready. Make sure you set a good look back period, okay? How much data do you need? In most cases, you need at least 200 samples. The number is more like 141 statistically, but look to pull in enough data to have 200 samples, at least 200, and that's the bare bottom, at least 200 samples of whatever it is you're testing. So if you're looking at a statistic and it has less than 200 samples, it's not a high confidence number. And so it's not something that that I would want to build an entire trading plan around. So if you're doing weekly, if you're looking at the weekly range, well, you can't just have 1 year of weekly data because you can't look at 52 weeks of data and base your data statistics on that. So for a weekly, I would pull in, for example, 6 years of data, so I have at least 300 weekly samples to do my study on. If I'm looking at a 1-minute bar chart, then I would probably look at a year of 1-minute bars. That gives you a huge number of 1-minute bars, but you need to go through at least a year of trading cycles for the seasonalities and the slow time in the summer and around the Christmas period and so on to do your statistics on, so you have some sort of a representative sample. So don't just blindly pull in data. Your data needs to make sense. Next, you need to set your periodicity. Periodicity meaning, are you going to use a 1-minute or 5-minute or 15-minute or 60-minute chart? Because I'm doing raw, I'm looking for a raw edge or high-level statistics, I'm using 60-minute data. I'm not at the point now in my studies or research to hone in on my time frame. So I'm not interested in looking at 1-minute data yet, although a subset of the statistics I'm about to share with you uses 1-minute data, and specifically the harmonic rotations of the ES or the natural ups and downs of the ES use 1-minute data. But otherwise, I'm looking at 60-minute chart. Remove all the non-relevant data. If you downloaded this data in the middle of a trading day, make sure you remove that trading day because it's not complete. It's not going to be a good representative sample, although it's just one data point. You just want to make sure your data is clean. And then once that's all done, I use filters. I use Excel for this. I'm starting to use IRT more and more because it has more powerful, it's become more easy. It's become easier to do statistical studies on it. It's very quick. But once you have your data, it's all about now using filters and formulae in Excel. And there are many videos on Excel and how to create pivot tables and how to create filters and things like that. And that's essentially what I do. All right, so let's look at this spreadsheet. Let me get rid of this spreadsheet. All right. So with this spreadsheet, I'm looking to answer some basic questions. And the questions that I'm answering are these. So this is my standard summary for a product. And I have this for each product that I'm considering to trade. Okay. So we start out with the gross, the specifications. What is the tick size? It's size, it's 0.1 of a point. One tick is 0.1 of a point. You can pull this right off of the CME website. Okay. So you can go to the CME. This is cmegroup.com. The product is on the CME, or if it's on ICE, you go on ICE. You go to the equity index group, which is what the Russell is. You click on the Russell contract. Okay. And then contract specs, and it'll tell you each contract's worth $50 times the Russell index. It tells you its trading hours. It tells you its outright value. It trades in 0.1 index points, which is $5. The calendar spread is trading at $2.50. You don't need to know that unless you're going to do that. What is the symbol? What is the listed contract? So it's on a quarterly cycle, March, June, September, December, and there are 5 contracts quoted at any given time. So the CME will always quote 5 contracts. It is financially settled, so we know it's not a physical product. If you hold on to it to expiration, you forget that the product's there. Once it settles, you'll simply be debited or credited whatever the amount is. When does it stop trading? It stops trading at 9:30 Eastern of the third Friday of the contract month, and so on and so forth. You can find the margins in here. You click on margins, and you could see that the margin, the maintenance margin for the Russell is 27.50. If the maintenance margin is 27.50, then the initial margin, the maintenance margin represents 90% of the initial. If you're initiating the position on a given day, then you have to have initial margin before the end of the session. Now, that gives you the contract specs or for the futures contract. To answer the question of what is the Russell contract, you got to go to that contract's parent company. Okay, so the parent company is a FTSE, and you can go into here. You can go into this FTSE.com, search for the Russell 2000, and you'll come to this page. Here's your fact sheet for the Russell. Very important. Most everyone does not bother to look at this. It's very important to know which sectors are controlling this product, right? It's also nice to know that, for example, these Standard & Poor's will tell you for the S&P what percent each of these sectors carries in this is represented by the Russell 2000 index. So, but we know that these are key sectors, so I have them on my charts, right? So if I show you my charts, here's a quote sheet, and I track those sectors. I have those sectors, I track them for the S&P, and as I do for the Russell, I also have them as bar charts. So the financials are represented here as a bar chart, and so are techs, and so is healthcare, and so on. Okay. So let's go back. So knowing what the holdings are, there's more. This isn't as good information as we would like. There's more information elsewhere. You can dig around and find what the sector distributions are. This answers that question that I showed in the presentation earlier of what sectors control this index or have the highest influence on the index. So back to the sheet. Here's it's financially settled. There are standard quarters, meaning March, June, September, December. Next, we get into harmonics, right? That's the first thing I want to find out. What is the normal rotation on a 1-minute basis of any given product? Now, you can do this using Excel. It's very long-winded and it's kind of difficult to do. Instead, what I do is I use a study that's built into IRT. It's called a fractal rotation study, okay? And what this does is it charts out the Russell. You can see here it's on a 1-minute time frame. The periodicity is 1 minute. I'm using a fractal, so how do you select, how does it know what a rotation top looks like, it's using 5 bars. So it's comparing the 2 bars before the current bar, the 2 bars after the current bar. If this current bar is the highest bar, it basically says, okay, this is the peak. And then it tests the low, and it looks 2 bars before, 2 bars after. If this is the lowest low, then it says it's the valley. If it goes from 1508.9, the peak, to 1507.8, the valley, this becomes the rotation. So the market has just rotated negative 1.1 points on a 1-minute time frame. And what I have here is 20 sessions, which is a month of trading of rotations. And you might think, well, gee, that's pretty short, looking at just a month. The fact is, from month to month, it doesn't change. The harmonic rotation of a product does not change much. And if you're rolling your eyes going, what the hell is a harmonic rotation? Who cares? A harmonic rotation helps us determine how much risk tolerance we should have for the product. If you have a product that has a harmonic rotation of, say, 22 points, and each point is worth 50 bucks, and you have a $2,000 account, then that's not a product you're going to want to trade, because there is no way for you to place your stop outside of a harmonic rotation without getting it triggered statistically often enough to be a losing edge, right? So what this chart does is it goes and it looks at these fractal highs and lows. You can see the zigzags here. It's drawing these zigzag bars up and down, and it's computing and it's plotting out for each one of these. See this 2-point rotation, it puts a 2-point dot. This is a positive 1.8 rotation, it puts a 1.8 rotation dot, blah, blah, blah. And it does so, it splits the up rotation from the down rotation. So this middle pane here is looking at the up rotations. This bottom pane is looking at the negative rotations. Believe it or not, I used to do this in Excel. It was very, very painful. And then ultimately what I want is I want to see what the profile looks like, and I want to know what is the first standard deviation, or what is considered normal for this product on an up rotation versus a down rotation. And we have those statistics here. So the most common rotation in the Russell with a 1-minute bar on 20 days of data, okay, on a 5-bar fractal is 0.8 points. That's the harmonic rotation of the Russell right now. That's the most, that's not the harmonic, that's the most common rotation in the Russell, from bottom to top, top to bottom, 0.8. But for rotations up, the normal rotation, or the harmonic rotation, is 1.6 points. So the Russell moves up in 1.6 point increments, up to 1.6 point increments, and it moves down in up to 1.7 point increments. And I put down the sample size so we know that it's substantial. So if I was planning for the Russell, I'm going to plan to make sure that I'm always taking something. I'm always taking some profit before 1.5 points, 1.6 points, 1.4 points. I want to take a scale out, because in its normal rotation, it's not always every time going to be 1.6 points in the direction of my trade. This is from bottom to top, right? And I'm assuming I'm not catching the bottom and getting out at the top. So I'm going to reduce my first scale out in the Russell, and I generally use about 0.9 to 1.1 points. That's the number of ticks. 0.9 ticks is points is 9 ticks. And so I'm always going to size. I'm planning to manage my risk by playing within this range, okay? An impulse move in the Russell is anything that's 2.7 points or higher. How do I get that? It's right here. So this second line here, essentially what it's saying is it's looking at about 700 data points. And if you plot the 700 data points over 20 days, 90% of those, that population will be under 2.6 points. That's the cutoff point. So only about, technically, around 10% of the time, the Russell go over 2.7 points or 2.6 points. 2.6 on the upside, 2.9 on the downside. The weighted average is 2.7. Okay, and so we know that when the Russell moves greater than 2.7 points, I'm going to pay attention. That's considered an impulsive move. That is a statistically unlikely move. So I want to watch a market that triggers that. And the way I track it is I have a chart, and I need to adjust these. I have a chart with these lines, these red lines. When this line is triggered, you'll hear it. When this line is triggered, and this should be 2.7, okay? When it's triggered, you hear that? The software warns me that the Russell has exceeded that extreme rotation. Russell zigzag high. And I have the same thing for the Russell zigzag low. When the Russell exceeds that rotation to the downside and crosses this red line, it plays an alert for me. Russell zigzag low. Okay, and what this does is it doesn't tell me I should trade, but it tells me that something unusual is happening. So the market will consolidate for a period of time, so you get these terrible rotations. See these rotations? They're about a point to a point and a half each, and then all of a sudden it starts to explode in a direction and give us a larger than normal rotation. And my way of trading is to see what's in the area. Do I want to fade this large rotation, or do I want to get trade in the direction of the impulsive move on the pullback? So I'll wait for a pullback to a key area and then take the long and look for it to continue in that direction. You'll notice that here, this was a setup short. The market did an impulse, had a small pullback, and did a second impulse into the mid and the open. This sets up a short trade, and then we're looking for 1.1 to 1.2 points to scale off risk, and then the rest I'm managing proactively. And in this case, it rotated 3 points. Hang on, let me turn down my. So I'm speaking fast. I'm throwing out a lot of numbers. Is anybody lost at this point? Are you guys lost? Is this making sense? It's a lot of statistics, and maybe it's a weird way of looking at the market, but I'm basically breaking down the market into statistical representations, okay? On any given, so now I'll move to the daily data. What is the most common daily range in the Russell? 12.6 points is the most common range in the Russell. That's pretty good, right? It's moving 12 handles or 126 points, ticks on $5 a tick. Pretty good. Okay, that's the most common. The normal range for the Russell is anywhere between 7 and 17.8 points. How do I get this? Here we go. I'm taking the daily ranges, so I compute the daily ranges here. Let's just look at day to day. I'm computing the daily ranges, which is just the highest high minus the lowest low of the day, of the prior day. I'm taking the daily ranges right here, so I'm computing all of them, and there's just tons of them, right? This is a sample of about 1,000. The sample size here is 1,070 days, okay? And then I take that data and I move it into its own spreadsheet, its own sheet. There it is. And then I look at what's the lowest value, which is represented down here, 5 to 7.65, 76.5. That's the range. So the range in the last 1,070 days in the Russell during regular trading hours, in other words, 9:30 Eastern to 4:15, has been anywhere between 5 points on the low end and 76.5 points on the high end. There's an average here, 15.6. But I don't care about averages. I'm not interested in moving averages. I don't care about averages in the data because averages do not represent the data set unless the data set is evenly distributed, normally distributed, which is pretty rare. Okay, so what I do is I use the data analysis tool, the histogram tool within Excel, and I go and I create a bin from the low range to the high range, 1776.5, right? So 76.6. I created a bin that goes in 0.2 tick increments, just so that data is not so spread out. And then I go through this process of first determining where is the point of control. The point of control is the highest here. See, this is a volume profile here. The point of control is the highest number in the data set. So once I determine the point of control, I start looking at the two prices above it, the two prices below it, and I start figuring out what is the value area that adds up to one standard deviation, one sigma. Okay, one sigma is 68.3%. I want to select 68.3% of the sample, which is 730, and then I start to select and figure out. So what I'm doing here is I'm creating a manual volume profile and value area for this range. And I determined that the range, the value area of the range goes from 7 to 17.8, and voila, 7 to 17.8. That is considered the normal range. So in statistics, the normal, when somebody says your shoe size is normal, it means it falls within 68.3% of all the people they tested. That's what constitutes normal statistically, 68.3. If you want more information on standard deviations, just go to Wikipedia, look up standard deviation, and it'll explain to you how that works. It's really a basic statistical concept, and I do it here manually to determine what are the ranges I'm working with. Why is this important? I want to know, the market just had a big move. Let's say the market had a 15-point move. Is that exceptional? Is that exceptional? Yes, you can use IRT for the range stats. You can use many charting platforms for the range stats, but I recognize that not everyone here has IRT, right? A lot of these studies have already been done by IRT. You can import the definition and just do them on the fly. But I'm doing this old school because not everybody is using the same software as I, but everybody has access to some sort of spreadsheet, either Google Sheets or OpenOffice or Excel or whatever. You can just export the data and get this information. You export daily bars and you bring it in and you do this same sort of study, okay? The next is, what is the volume? What's considered a high volume day versus a normal volume day? So same thing. I take the volume. So what's the daily volume right here? This column right here, daily volume. I take that, I export it, I copy and paste the data over here. Okay, for each day, I binned the volume in 2,500 contract increments from the lowest amount to the highest amount down here, 292,500. And I ran the same statistical study. I did the histogram again, and it looks like the most common volume falls at 92,500. So the Russell, the most common volume is 92,500, and the range of what we would consider to be normal volume in the Russell is 52,500 to 127,000 contracts and a half contracts. Why is this important? Again, it helps you understand the nature of the product. Is today's action really outstanding? Or is it within the normal range? And what we see here is, oh, we had a 15-point move in the Russell that represented the low to the high, and that's actually, even though the move looked like it was crazy, it's actually within the product's normal daily range. And of course, this depends on how many days you select in your data set. Anyway, I know I'm like loading you with information, but these things are important for me to determine the nature of a product. And doing it manually gives me this kind of granular feel for the product before I start investing my money in this. Okay, the point of control is the mode, statistical mode. It is the most common of all the data that you've imported or you're looking at. That is the most common occurrence. So then we look at the weekly data. What should I expect on a weekly range? Okay, the most common weekly range from low to high across all sessions is 36 points. So 36 points is about the most common. The normal weekly range is anywhere between 24 and 48. Why do I need this? It helps me when I'm looking at my weekly chart, my weekly profile. It helps tell me, is this a normal week? Or is this exceptional, or was it too tight? How is this week performing versus history, right? So you look at this week here, and you can see that it's exceptional. And because it's exceptional to the long side and it closed near highs, statistically speaking, and using just standard auction methodology, we know that there's a high probability of a continuation move because this is an impulsive, this now becomes an impulsive move for that week. Okay, this is about a 54 point week 2 weeks ago, a 54 point week, and what's normal is about 24 to 48. This is an exceptional week, right? This is an exceptional week. So the expectation is the following week is that we're likely to see continuation in that direction. Okay, so this is the unsexy part of trading. This is the part where you're kind of squeezing every piece of information out so that you can properly plan for and trade a product. This is where people tend to fall short, and this is where those who are going to have a fighting chance making money at a product go to get their edge. Okay, now let's look at the overnight statistics. So what we're looking for here is the question we are looking to answer in this section, and now we're getting into the nitty-gritty of edge in percentages. What we're looking for here is how often, so many of you have seen the statistic in the ES, and now here it is for the Russell. How often does the Russell break the overnight high, the Globex high or low, touched or break the overnight high or low during the day session? And the answer on 1,045 days where this happened is 98.3%. So 98.3% of all the days we tested, either the high or the low was touched or broken. Okay, so if I'm coming into the day session and I can see that the overnight high is a certain price up, the overnight low is a certain price down, and the market is gapping up and it's starting to sell off, the overnight low becomes a key target for me because it has a statistical probability of somewhere within 98.3%. It doesn't mean that 98.3% is the probability that the low will break, because that includes the high as well. So it's a high probability play. I know that if it starts to move towards the low and doesn't break it and comes all the way back and pushes through the mid of the overnight session, then I know that the short was wrong. And I know that now there's an even higher chance within that 98.3% statistic that the overnight high is going to be taken. I know that there's a very, very high historical probability that by the end of today, last night's high or low will be taken out. So observe it over the next few days in the Russell. How often do we go and touch or break the overnight high or low? The next stat is how often are we just taking out or touching the overnight high by itself, 69.3%. That leaves 30% of the time it doesn't get touched. It's a pretty good edge, 70% edge. Overnight low, broken, 66.1% of the time. 2/3 of the time, 2/3 of all days tested historically, we've touched or broken the overnight low. Pretty good. It's a pretty good start. It's not quite an edge, it's not a setup, but it's giving you an idea of the nature of this product. And how often does it break the overnight high and low. So we know that only 1.7% of the time it's not breaking either one. The overnight high or low stay intact by the end of the day session. And we know that 63% of the time or so, one of those is broken. One or the other is broken. 37.1% of the time, both are broken. So if you were to put on a trade short, let's say, and then the market starts to move towards the overnight low, and you put your stop above the overnight high, historically speaking, that stop will trigger over a large sample. That stop will only trigger 37.1% of the time. Okay, 63% of the time, your stop will be fine. Okay, so you can see that that is a gross edge, right? I'm not saying that that's a setup to trade, but it's a gross edge. How do I arrive at that number? Well, a separate study. I bring in the overnight session, I bring in the day only session, and I test out. I check them. I make sure the days match. Do these days match? Yes, 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 yes. They all match. Now I start to look at, did the overnight high get touched during the day? Did the overnight low get touched during the day? Did both the overnight and the low get touched during the day? Did neither one get touched during the day? And that's where that 98.3% statistic comes from. The overnight low and high don't get touched, or high don't get touched 1.72% of the time, which means that either one will get touched 98.3% of the time. Are you still with me? Are you still awake? Is this really, really dry? Because we're talking statistics. It probably is. But you know what? If you're trading without statistics, you're probably guessing or just copying someone else. Okay? Next, we look at IB stats. IB, the initial balance, is the first hour's high and low. Why do we use the first hour's high? It comes from Peter Stadelmeier, and it comes from his trading in the pit. He used 4 trading brackets, which were 15-minute brackets. And what he decided was the key participants in the market generally get their market on open orders or their business done in the first hour of trading. So we start to use that as a measuring stick, as a totem pole, right? Totem pole, no, I don't think that's a tattletale. We want to use that as a marker, okay, to tell us something. And we want to, if we can measure the first hour's high and the first hour's low and decide what the rest of the session looks like in relation to that first hour. Remember, the first hour of trading statistically has the highest volume of the day. So if we look at any product, okay, let's minimize this. If we look at any product and we look at its volume, you'll find that the first hour of the day has the highest volume, then it drops. Highest volume, then it drops. Highest volume, then it drops. Highest volume. This morning, highest volume. See, this is the first hour. The first bar ending at 9:30 Chicago time, 8:30 to 9:30, then it drops. First hour, then it drops. So a lot of the day's business, okay? Yeah, not the Bund, because the Bund opens an hour before the cash market, and you have to. So for Eurex products, I use 2 hours for the IB. It's a special case. But in general, in a normal market that follows its stock, like if you look at the Euro stocks or the DAX, and you compare the IB and you set your IB based on the first hour of trading of the stock market, which now it opens an hour earlier, that's the number we need. Okay, so when we look at the initial balance stats, we want to know what is a normal initial balance. Okay, if the initial balance is very tight, then you have 2 things that could take place. The initial balance is, the most common initial balance is 8 points according to this study, and it can go from 5.4 to 11.8 points is what's considered normal. on 1,070 days, if we open up and there isn't a holiday and there isn't some crazy number that we're waiting for, a crazy announcement that we're waiting for, and then the Russell is trading at, say, a 5-point initial bounce, it is just really tight. It opens up that morning and it's just doing this. It's just really tight. This is important to know because when you open really tight and there isn't anything holding the market up, and that's a horrible color, it's like, and the market opens up and it's in this 5-point range, and there isn't something holding it up that might cause it to be so slow, it's very likely to have a very strong move out of that range, assuming there isn't something holding it up, news, an announcement, FOMC, something, okay? Why? It was described by Dalton as a base for a lamp, okay? The wider the base of a lamp, if a lamp was this tall and had this wide a base, it doesn't fall over. It's very hard for it to fall over. But if the lamp is the same length, but the base is this wide, it tends to tumble over very quickly. The same mechanics kind of occur with the initial bounce. If you have a tight base, look out for a trend day. Look out for a day that just starts to just rocket out of where it is, okay? Versus a day that has a very wide initial balance. You know, in the morning, in the first hour, traded way up here, and it traded down here. Chances are it's going to sit there for a while throughout the day before it breaks the initial bounce high and low. I'm getting drawn in here. I've used up an hour, and we're not even close here. So that's important. Now, here are the statistics that then get tied to the initial bounce. The initial bounce, the first hour's high or low, is broken 95.6% of the time. That's an edge. So on any given day, the initial bounce will get broken, not touched, okay? Not touched, but broken by at least a tick 95.6% of the time. That means on any given day, this yellow line will get breached at some point before the end of the session. 95.6. It's hard to get those kinds of statistics, right? So you can incorporate that into your trade management plan or trading plan as you go along. The initial bounce is broken almost 2 out of 3 times in the Russell. Why? We've been on a rip-roar trend upwards. The initial bounce low is broken 58.8% of the time. Both the high and the low get broken 21.7% of the time. What is the edge in knowing that neutral, that the definition of that's neutral, when the initial bounce high is broken and the low is broken, that's called a neutral day type. What is the edge in knowing 21.7%? Can anybody guess? Anyone? What is so important about knowing that both the IB high and the IB low are broken 21%, 21.7% of the time? Right. What this means is the opposite of this, right? So 100 minus 21.7, 78.3% of the time, once it breaks one side, you can put your stop on the IB high plus a tick, and historically it has not been triggered. That's a high probability, 78.3%, right? And so that's why it's important to know. Once the market has gone neutral, how often has it closed inside of the IB? In other words, the market has, like it did a couple of days ago, right here. So it broke the initial balance high right here, and then it broke the initial balance low, and then this day it ended up closing in between the IB high and the IB low. In other words, it went back into the range. Whereas this day, it broke the initial balance low last Tuesday, and then it broke the initial balance high, so it went neutral and it closed outside. Well, what the statistics show here, based on the sample, only 232 neutral days in the sample size, it's saying that 60% of the time, it'll close outside of the IB. It'll close outside. So if you initiated your position inside before the neutral day happened, you have, historically, there's a 60% probability on a large data set that it will not come back into the IB. Another important stat. Neutral following neutral. If you have a day where the market went neutral, okay, so here's a day that went neutral. It broke the IB high and the IB low. What is the probability that the following day in the data set historically, that the following day will also be neutral? In that case, 22.4% of the time, which means about 78% of the time tested, the data tested, remember this is historical, 78% of the time, you won't have a neutral day. So if yesterday, let's pick a day. If yesterday it had a neutral day and then the market the next day breaks the IB high, it has a very low probability of having another neutral day. So if you want to use a wide stop, a pretty good estimate or an intellectual guess would be to put your stop below the IB low if the IB high is broken, because yesterday was a neutral day. That's what that number is used for. Days where the market does not break the IB high or the IB low, 4.4% of the time. So almost that statistic is sticky across pretty much every index that I test, that the market always breaks the IB high or low. Non-trend day is a day where the market does not break the IB high or the IB low, but the IB is less than 5.4, which is the low end. So the difference between non-trend day and no IB break is the size of the initial balance. In this entire data set of 1,070 days, there was only one day where the market traded 5.4 points of the initial balance and it didn't break it. Okay, those are dead days. Generally, day before Christmas, but it's a full session, so I can't remove it, and so on. 77.3% of the time, again, this statistic comes from here, it'll break just one side. That's very important to know. Again, this is a good way to define this is better than a 50-50 chance of defining your stop if you want to use a wide stop. Once the market breaks one side of the initial balance, there's historically a 77.3% probability on 1,023 days that it will not go and hit the other initial balance. Okay, close above the IB, 54.5. So these are break even. These are not very useful stats, yellow. What happens if it breaks the IB high? How often does it close above the IB high if it breaks the IB high? So the market has broken through. So let's use a different color. I'm going to try to speed this up because I'm really chewing up a lot of time. Here's your initial balance. Market opens, tests low, okay, tests high, comes back, breaks. So this is where it broke the IB high. This is the first hour's high, first hour's low. What this number here is saying is 68.6% of the time, okay, it's going to close above the IB high. So if you're in here, you need to hang on until the close. This is a stat that helps you hold on to a trade. What about the IB low? If we break, so inverse this, and we break the IB low only one side, then 76.8% of the time it'll close below the IB low. We just had a day like that because I bet on it. Hang on, what day was it? Right here, that was yesterday. See how it came back? It tested the IB, but ended up closing underneath the IB. That's a day that would trigger that statistic, okay? This is a really big one. This is proprietary. I wasn't gonna release it, but I figured I'd throw everybody a nugget here. If the IB high is broken on any given day, if the IB high is broken on any given day and the IB low is not, the market closes above the mid. So instead of putting your stop all the way below the IB low, please tell me if you don't understand what I'm talking about. Just tell me so I can explain it really quick, because this is really important. If the market breaks the IB high, so here's the IB high, here's the IB low, the market trades down, then it moves up, then it holds on, and then it breaks. So you might put your stop here, right? And you would be betting on the neutral. So you would be betting on this. You'd be betting on the 78% probability it's not going to go below, it's not going to break this price, right? Well, if you keep track of the mid, which I do, right? If you keep track of the mid of the session, whatever that mid is, then you can tighten your stop, your sell stop, on the initial balance break high and be safe, potentially, past performance not indicative of future results, 93.6% of the time. It's mid, the mid is the high and the low divided by 2, okay? The mid is always on my charts. So if you look at my charts, this blue line, that line is the mid of the session right here. It's taking the high and the low divided by 2. The high, the new low divided by 2. The high, the slightly lower low divided by 2. And it's keeping track of what is the 50% pullback of the entire range. So what that stat is saying, like I said, is now instead of betting on a lower statistic, which is neutral, which with a wide stop, your stop could be, after it breaks the initial balance high, your stop could be 8 points wide. Now you can cut that in half and be okay, technically, theoretically, 93.6% of the time. That's huge. I can build a trade around this line right here. And the same idea, the IB low is broken, but not the IB high. How often does the market close? So it can come back and retest the mid, but how often does it close below that mid? 86.8% of the time historically. Okay. And then finally, looking at just, there's a lot more, by the way. I just didn't want to overwhelm you. There's a lot more. There's a lot of stats that I can get into, and this is all just preparation stuff to then devise a statistical edge that I can trade and be profitable in, hopefully for the long term, trading this product, right? I don't just jump into a product because somebody talked about it. I have to prepare myself for it. And that's how I prepare for it. And that's how I can put on size in this product and not freak out just because the market's not going in my direction. Okay. Thank you. Very well done. Below. Let's close below. We need to fix that in the PDF. Then opening stats. If the market opens above, how often does the market open above prior range? 184 of 1,084 days, 17% of the time. If it opens above the prior range, how often does it test value area high? Value area high is this gray. It's the first standard deviation of all volume in this data set. Okay. And how often does it test it? Half the time. Okay, that's what's called a gross statistic, because that can change depending on where it opens versus the yesterday's range. You know, is it opening 10 points higher? Or is it opening a tick higher? This takes all of that into account. It's not discriminating, and it's saying 49.5% of the time it'll touch value area high. And if it does touch value area high, and this is where it kicks in, where does 56 have a type of close below mid on IB? Low only break on 3. Yeah, I don't see it. Anyway, this is where the statistic kicks in. So if we open outside of above the range and we touch value high, then we have a 72.5% probability of touching the point of control. How does that look? I'll draw that for you. Okay. We draw that. So the market Gaps open higher. Let's see, where do we have a gap open higher? Not recently, I guess. Hang on. So we don't have a gap higher. Here we go. There's a gap higher. This is a gap higher. No, it isn't. Prior. Wow, we haven't had a gap higher in a while. But what this is saying, no, it didn't gap open higher above the range. It has to be above the range. The range yesterday is 1518, right? 1518, and we opened in range today. So let's say the market opens, and I'm just explaining this to you. Let's say tomorrow morning, the market opens up here. It's above the prior day's range, and it trades. There's only about a 50% probability that would come back and touch the value high, the edge of this gray area, this little gray line, okay? If it does touch the value area high, there's a 72% probability that it would touch the point of control. We're not really betting on this statistic. We're betting that if we get short and it goes and it touches value high, then we're going to stay in this trade. We're going to play that statistic that I just talked about, right? We're going to play that 72.5% statistic. We're going to stay and not get shaken out because we have a good chance, better than 50-50 chance of getting down and touching that point of control, which is this pink line. So if we touch the gray, if we open above and we touch the gray line, then we have a 72.5% probability of touching the pink line. And then we test the same thing from below, and from below the stat, it only gapped down 11.5% of the time. If it does, it'll touch the value low from below 52.8% of the time, and 2 out of 3 times it'll close the point of control. Okay, so those are just some. This is about half of the normal sheet, and I'm way over my time. I've used up an hour so far, so I don't want to kill you guys with this information. I know it's pretty dry, but I got to tell you, this is what builds careers, right? Once you get a good plan and you start to look at your execution, now you're building something that is definitely sustainable. So here's where I'd like you to go to grab a copy of the sheet. I'm going to adjust this sheet so that it reflects the correction of the typos and stuff. This is the URL you need to go to, ft71.com/Russell2K-stats, okay? And it's gonna ask you to add your name to the site, okay? There's no spam here. I'm preparing to launch Convergent Trading, which is the trader development program, the Emerging Trader Pro Trader program. And I'm looking for, I'm collecting names to see who would be interested. So you might get a message in the future asking you if you want to hear about this program, but there is no spam here. So if you want to get a copy of this sheet here, a corrected copy, go ahead and put your, go ahead and fill this out. And this is the URL, ft71.com/Russell2K-stats. And it'll bring you to this page. Just add your name and it'll shoot you over that PDF. Okay. The same principles apply to all products. All products. If I'm trading a stock, I'm looking at the same thing. Okay. This is universal. If I'm trading houses, if I'm getting into the house flipping market, I'm going to try to get that information, kinda, and figure out what my edge is in this market. So the reason I chose the Russell is because it is tougher. The main reason I chose the Russell is because it has some statistics that are better, that show up better than the NASDAQ. The NASDAQ 100 has a lot of ARB in it, a lot of statistical ARB in it, a lot of algos. The Russell has 2,000 stocks. It's a small cap. It's a tougher market for algos the cash ARB algos to participate in the Russell, because you cannot actually get the 2,000 stocks, and if you did, creating an algo that that arbs these products is very, very difficult in the cash market, right? So you have to use an ETF or something else, and I find that it's a cleaner trade than NASDAQ. And the reason I haven't talked about it before is because I couldn't stand the fact that that ICE was charging $110 for data, and now the Russell, the RTY, is included in your data package for the S&P. What to expect when you make a change? So you're going to make a change. You decide to make a change. I want to make sure you set your expectations right. You will need to be patient. You will take losses for longer and more often than you anticipate. You're learning a new product. You're going to take a hit. So be prepared for that. You'll become a more agile trader. That's something you should expect. If you've always traded the S&P and you're stuck in the S&P and you start doing homework on the Russell and so on, you'll learn some things that you can bring back to the S&P. Okay, you'll become a much more agile trader. Almost all successful professional traders that I know trade across many products. It's not something I'd recommend for someone who's not consistent, but eventually you need to diversify and trade many, many more products. By cleaner, the Russell, by cleaner, I mean I can see the rotations better, tends to follow through better, and so on. The NASDAQ does a good job. The S&P has been doing not such a great job, but the NASDAQ has been doing a good job of following through and so on. But I do like the fluidity of the Russell. It tells you very quickly whether you're right or wrong, and the Russell can run for longer. The other thing about the Russell is it's not controlled by Apple, it's not controlled by Google, it's not controlled by Facebook. It's the stocks in it are smaller. The average stock in there is about I think 800 million or 2.2 billion. I forget. It's on the sheet actually. Hang on. The average market cap is 2.2 billion. The median is 800 million. There's much smaller companies. They're less likely to just go shooting off like the NASDAQ does, right? Like it did today. You'll need to be deliberate. So expect to be very deliberate about practicing. You need to be calculated about how you approach this market or the new market. You need to be focused on what you're doing. That's all I have for you. If you have questions, please hit me at FuturesTrader71.com/contact or on Twitter. My handle is FuturesTrader71. Terry, I went over by about 15 minutes. I apologize for that, but I think we covered a lot of ground today.
No,
probably
absolutely.
some headaches in there too.
No, it was great. This is a really good webinar, and I'm
very cool.
Absolutely. Thank you very much. And I don't even know what to say. My mind is blown right now.
Well, I know we have some questions in there. I would suggest that folks who really have questions to just try to get a hold of me online. I would suggest you enter your name in here to get the sheet, but also it'll be a way to kind of continue to communicate as this new company is being set up. I think we're over time here for questions, right?
A bit. I know you answered quite a bit because you're reading the questions as you're going, so I'm just trying to scroll through if I see anything that I didn't see get an answer. Let's see.
You know, the other thing is there's an AMA. I have an AMA thread. That's a great place
Absolutely.
to actually put your questions.
Let me.
Because I'd love to have a conversation in there.
I'm going to grab the link. I'm going to post it real quick. There we go.
Yes, Rick. Rick, if you're trading crude, it's the same thing. Same thing. Same thing. Whatever you're trading, bonds, notes, 10 years, 5 years, whatever. Bund.
All right, there you go, fellas. It's
Great.
been posted to the questions and to the chat. So in the chat, you can click the link, go there, ask your questions. Feel free to check out FT71's link here. As always, you can message him and mention him on Twitter, and he'll get to you as well. So thank you for the webinar, and have a good evening.
Thanks. Take care.
Absolutely.